You shouldn't even think about it until it's 50 to 1, in my opinion. It's coming out of the ground at 7 to 1. It's averaged about 45 to 1 for the last 100 years, price wise. And that was with a 16 to 1 geologic ratio. Now it's 7 to 1. It's disappearing. And the demand for it is out of control, with the U.S. government just classifying it a critical mineral.
When you do some research, you find that at local coin shops, there's a lot of people that are selling. And when that is done, and it will be done sometime soon, first of all, they're going to regret it. But second of all, without the people selling, it will explode. And just wait until gold also gets into all-time highs again. Once gold and silver are both in all-time highs, I think silver is going to turn into a rocket ship. He's got a target of $85 in a matter of 3 to 4 weeks. It could even be higher than that. I don't know.
Silver investors pay very close attention, because right now the signals coming out of the physical metals market are unlike anything we've seen in decades. Silver is breaking records around the world, insiders are abandoning the tech bubble, and the U.S. government has quietly elevated silver to a critical mineral for 2025, something that has never happened before. At the same time, Comex is experiencing one of its biggest physical delivery surges on record. Tens of millions of ounces are being demanded in real metal, not paper, and it's happening while retail investors are still busy chasing AI stocks. This is exactly what Andy Schectman and Mike Maloney have been warning about. When insiders exit equities and move into physical silver, the clock starts ticking. Because once gold hits new all-time highs and silver finally breaks free, the move won't be slow. It will be explosive. Today, we're going to break down why the next phase of this market may unfold far faster than anyone expects.
The fact that gold is up 70% and the S&P is up 16% amidst the greatest tech boom in history with the AI, and the insiders are selling $2 billion a week since June. It's not just Buffett. You got Bezos sold $7 billion in Amazon. You got insiders and board members of NVIDIA dumping a couple billion in stocks. You got Zuckerberg dumping, Jamie Dimon dumping, and the institutionals dumping, as the public is all in on stocks. The largest allocation to stocks they've ever had, 45% or so of the market is by retail investors. The largest exposure to options, which is speculation, and the largest exposure to margin debt, which is leverage, at all time, $1.5 trillion in margin debt, as the insiders are selling. And who the hell is buying billions and billions and billions and billions worth of gold and silver since November? Every month, we're net importers of gold for the first time in my career, and other than brief episodes, maybe ever. So who's buying all this gold? People at that level don't do things just for the hell of it. They know what's coming. At the same time, they're quietly exiting the equity markets as the public's all in. So I would say, whether or not Warren owns it, I think it is being accumulated by the most well-funded and well-informed traders in the world. And you can see that not only by the bleeding down of metals out of the LBMA, the massive deliveries way out of the ordinary every single month here on Comex. Again, just the first 2 days of the Comex contract, the December delivery, and I didn't see yesterday, which had been the third day. Day one, December silver contracts, 7,330 contracts stood for delivery. That's 36.65 million ounces, worth more than $2 billion. Not a record. April saw 11,692. And as mentioned further up in the daily delivery report, we're only into day 2 of the December deliveries, and there's already been 2.397 million ounces of gold delivered, plus a knee-wobbling 41.525 million ounces of silver issued and stopped. Those are in 2 days. You're talking billions of dollars worth of gold and silver every single month. Who the hell's doing it? That's the insiders, who are the most well-informed, the same ones that are leaving the equity market. You wonder if Warren is in there? Probably is, through some sort of a fund or whatnot. And when you buy stuff on the CME, there's no disclosure.
And it's in the 70s right now, I believe. And, it was I made some large purchases during COVID when it was up. I didn't nail 120 to 1, but I did get some that were way over 100, like 110. However, at 70, silver is still an extreme bargain at 70. It went to 30 in 2011. It went to 14 in 1980. And that day is coming again. But with the fundamentals underneath what's happening in silver, I would expect that we could go down way below 14 as far as the ratio. Silver's big move from the fours into the 20s occurred while there was a silver deficit like there's been for the last 5 years. Then when it hit $48 in 2011, that spike, a whole bunch of people went out looking for silver. Takes a minimum of 5 years to get into production. And that's the reason you're seeing these small positive numbers. We had a deficit. The deficit went away, but there's this delay. And that delay is good because now it's saying that we're probably not going to get back into a positive situation with silver supplies until the 2030s. It takes a really high, the cure for high prices is high prices because it'll bring more to market, except to find a discovery, to turn it into a mine, and to get that ore above ground and refined into bars takes 5 to 10 years. There just isn't enough. There's not going to be enough for at least until the end of this decade. And that means super high prices. When you go to that market balance, less exchange traded products, that's 7 years of deficit.
Andy Schectman begins with the most overlooked signal in the entire metals market, the gold-silver ratio. Silver comes out of the ground at roughly 7 to 1 compared to gold, yet the market continues to price it as if it were abundant. Historically, the ratio hovered around 45 to 1, and during silver's major bull runs, such as 1980 and 2011, the ratio collapsed into the 14 to 30 range. Today, we are still far above those fair value zones, which tells Schectman and Maloney that silver remains one of the most undervalued assets on the planet. But valuation is just one part of the story. The structural supply deficit is now entering its 5th consecutive year, and even optimistic projections don't see a return to surplus until the 2030s. Mines take 5 to 10 years to develop, and global demand from solar, EVs, semiconductors, medical tech, and energy infrastructure is accelerating faster than new supply can be brought online. Layer onto that the U.S. government's unprecedented 2025 decision to label silver a critical mineral. That changes everything. It signals strategic importance, encourages stockpiling, and shifts national policy toward securing supply. For investors, it means increasing competition for physical silver from industry and government, not just the investment world. Meanwhile, the biggest reveal is happening behind the scenes: record physical demand on Comex and LBMA. In just the first days of the December delivery window, over 7,330 silver contracts stood for delivery equal to 36.6 million ounces, plus more than 2.39 million ounces of gold delivered. That's more than $2 billion in physical metal demanded in days, not weeks, not months. And this isn't retail buying. This is institutional-level positioning. Andy notes that at the exact same time, corporate insiders at major tech firms, Amazon, Nvidia, Meta, and even major bank executives have been quietly dumping billions in stock while the public goes all in. And Mike adds that today's derivatives-driven markets are far more leveraged than in 1980 or 2011. Back then, there weren't hundreds of paper ounces for every real ounce. Now there are. That means any forced move toward physical metal could cause the system to reprice silver violently higher, faster than models can predict. Maloney concludes that if gold merely doubles, which many analysts see as conservative, silver could outperform gold by 5 to 10 times based on historical ratio collapses. In his words, the potential here for silver is enormous.
Yes, I had you invert it so that it show when silver is outperforming gold, this ratio is going up, not down. But you can also do the silver-gold ratio, but then the scales on the side are in 0 point something or 0.0 something. And our brains just don't work as well that way. I wanted it in whole numbers. And so the gold-silver ratio provides that. And this also, So whenever it's going up, silver is outperforming gold. But look at where it was in 2011, where it was in 1980, and then look at how undervalued it's been from 1990 until today. It is still an extreme bargain. It is dirt cheap. Now, look at what the average was, that red line going through all through the 70s. That red line, the 2011 peak, it only visited what was considered fair value against gold all through the 70s. That was like the natural balance of the gold-silver ratio was about 30, and that's what it hit. It wasn't. There was an intraday, I think, where it hit 30, not 31.7. So this must be end of day, or maybe, it's not weekly. It's end of day. And 14 in 1980. So from where it is right now, it's saying that it should outperform gold easily. It'll outperform gold 2.3 times, and it could outperform gold by more than 5.2 times. And gold is still, I believe, a minimum of a double in dollars. And so you take this 5.2 times 2, 10.4 times, and that is the minimum. But the gold silver ratio could easily, when it hit 14, there was a huge strategic stockpile of silver that the U.S. had. They've sold it all off. The above ground stocks were far larger than they are today, far, far larger. Today, we are in a situation, and you didn't have, derivatives trading was very new. You didn't have hundreds of ounces of paper contracts for each ounce of real deliverable silver. The potential to blast past that 1980 peak of 14 exists. So if you're at 73 and it goes to 10, you got 7.3 times the return on silver that you would get at gold, and gold doubling that. The potential here for silver is just enormous.
Before we wrap up, here's the one question I want to ask you. Do you believe silver's next major move will be a slow climb or a sudden, explosive breakout once gold hits new all-time highs? Here's the reality. The same one Andy Schectman and Mike Maloney are warning investors about. The next move will be explosive. Andy is seeing insiders drain physical metal from Comex and LBMA at a pace he's never witnessed outside of major financial turning points. And Mike warns the gold-silver ratio is still wildly distorted, meaning silver hasn't even begun its real move. Once that ratio snaps back to historical levels, silver could outperform gold by multiples, not percentages. Their message to investors is simple. Don't wait for the breakout to believe it. By the time the public reacts, the insiders will already be gone, and the opportunity will be over. If this breakdown helped you understand the real signals behind the gold and silver markets, make sure you subscribe right now. The next few months could be the most important period the precious metals world has seen in decades, and you don't want to miss the updates that truly matter.